My name is Gerard Barron, and I am the CEO of the Metals Company, and we're all about opening up a new supply of battery metals in the form of polymetallic nodules. And we've identified around 1.6 billion tons of these that sit on the ocean floor on two of our license areas, about 1,000 miles off the coast of Mexico in the Pacific Ocean. And that's enough nickel, copper, cobalt, and manganese to build around 280 million mid-sized EV batteries on an NMC 811 chemistry. So it's a very large resource. We've been at it for over a dozen years. These nodules were first discovered way back in the 1870s. In the 1970s, they started to collect them. They built the technology that went 4,000 meters below sea level to collect them, and Rio Tinto built a processing plant. But of course, 50 years ago, the regulations did not exist, and so the United Nations stepped in to stop them. And that's the exciting thing about this very moment in time. The final piece of the regulatory regime is about to fall into place, which means that this resource is about to be open to business. So it's an exciting time.
TED Talk. No, that was very good. I think I just spoke to you over at a conference a few minutes ago, dragged you over here because I wanted an update. I know Marlon spoke with one of your team a couple of weeks ago. But I think Marlon came back to bouncing and saying, I think this thing's actually going to happen. Right? So, and that's a kind of big sea shift from when we first spoke, because I think those conversations full of emotion and all of that kind of conversation and rhetoric and obstacles and things that could get in the way of a rational business. You've moved it quite a ways down the track using your science-based arguments and facts about how you're going to do this and not damage ecosystems and feed into a system which wants what that is. So it looks like a lump of coal, but it's not. How's that break down? What's in it? I know what's in it. How's it break down?
It's 30% manganese,
right?
1.3 to 1.4% nickel,
okay.
1.1% copper, and about 0.2% cobalt. So it's a hydroxide. If you put all of that into nickel equivalent, we're about 3.2% nickel equivalent. So, yes, magnitude of order bigger than some of the assets that are being contemplated to development at the moment.
Absolutely, and we need bigger, we need scale, and we need to see. So let's just talk about how you've moved from what I first saw to where you are today in terms of the objection handling side of things. Mm-hmm. I think the biggest thing, obviously, clearly was the emotional component. So you had to break that down. How?
Well, I put it into three boxes, actually. I'd say, firstly, we had to attract a team of people that were very mission aligned. Mm-hmm. And so when I took over running the company in 2017, I assembled a team out of the oil and gas industry, out of the mining industry, out of robotics, and we put together a really mission aligned group of people. And I'm happy to say that team of people are stuck through thick and thin. And then in the other box, I put partners, because it's complex, right? These are 4,000 meters below sea level. And as anyone in the mining industry knows, processing is really another big challenge. So what we did is we went and brought partners in. 2019, we invited Allseas. Many people won't know them. They're a private company, Swiss-based, but out of Holland. And for 37 years, they've been laying pipe in the deep ocean for the oil and gas industry. And so they wanted to move into this business of helping to pick up nodules. And so they had been building our first production system, and last year we were on the water for 6 months testing it. It was a great success at every angle, and we brought home around 3,000 tons of nodules. To do that, we also acquired the Hidden Gem, which was a former drill ship that was a $700 million asset in 2011. They bought it for less than $50 million, converted it into our first production asset, built the robot, built the vertical transport mechanism, and then put it to test. And of course, we tried to achieve that by ourselves, well, it's unlikely it would have been the success that we saw last year.
We'd blow the capital structure out of the water.
We totally, yeah, exactly.
Right.
And, as I've always said, we don't want to own boats. We don't want to own production vessels, because there are other companies out there who really like owning them, who are really good at managing them, and who in return for long-term contracts will put those assets to work. And the same with the onshore processing. We recently announced that we've been working with a Japanese company, Pacific Metals, And since 1965, they've been processing nickel ores. And the good news about this is we completed our onshore pilot processing work over the last few years. They behave very analogously to nickel laterites. And so this particular facility in Japan has been processing nickel laterite ores for decades. And of course, if you know anything about nickel laterites, a lot of them are in equatorial range. They're all in equatorial rainforests. And Indonesia has banned the export. And so some of these processing facilities could become orphaned. And so for us, it was a perfect match. And they know a lot about the processing side. And secondly, they're looking for a new feedstock. And what we've are in the final throes of negotiating now is that tolling agreement that will allow us to send our nodules to Japan, where they'll be processed and will produce a very high-grade manganese silicate product that will achieve 100% of the payables for. We'll produce an alloy material containing the nickel, copper, cobalt, and that will basically, we hope to get about 70% of the payables on that product for no capex. Yeah, so that's a bit of a game changer. And then finally, on the environmental side, you're right. It's been a big focus of our company. And, you know, we often hear that we don't know enough about this part of the planet, that we know more about the moon than we know about the ocean. That's categorically wrong. In this one little part of the ocean, the CCZ, we know a lot about it. We have 180,000 square kilometers of bathymetric survey data. We've just uploaded, in the process of uploading 200 terabytes of data that we've gathered over the last years, down to the granularity of box cores, where we've gone and collected parts of the seafloor and studied the organisms and recorded them. And people are going to be blown away with the science. And of course, that's our effort. And we've been leading the charge on behalf of the industry for the past decade in this area. But there are many other contractors. And what we're now doing is gluing together our data and their data so we can get more of a landscape picture and put to bed the argument that we don't know enough about this. And so far, all of the science that is coming in is in line with our expectations and very encouraging to the thesis that we can dramatically reduce all of the impacts of collecting and turning these rocks into battery metals compared to the land-based alternatives. Right. Things like reducing CO2 emissions by more than 90% when you build a battery cathode from this compared to land-based. Things like zero tailings and zero waste. So obviously, as we start to release more of that data this year, and then ultimately when we lodge our application with the regulator, that will put people's minds at ease, I believe.
Okay, great. You answered the question you wanted to answer. I like that. So the emotional bit you can end up with at the end, and I think you've sort of hit several of the talking points as well in terms of the technical and some of the financial. Do you mind if I then skip through and get a bit more detail on the financial? You talk about, clearly it's a massive capex. If you as a company were trying to do it yourself, you couldn't. There'd be nothing after the company. So you've got a couple of JVs in there. Will there be additional JVs, additional monies come from outside partners where you're kind of splitting up the pies? The size of the prize that I want to talk about. If I take everything that you said as true, because we had enough conversations about the different aspects of the business, I'm going to say, right, if all of the things you said are true, what is the size of the opportunity and how do you go about funding that? Who do you need in place to do that? What's the timing? And the end game is getting these things off the surface of the seabed up and processed on land. So how does all that come together, and what do you think the potential is for you and current shareholders?
Well, it's about protecting the equity. You're right. I mean, if we went down a path of wanting to build our own boat, of wanting to build our own processing plants, there'd be no company left. And we had to do that when we constructed our first preliminary economic assessment, because we hadn't done those deals. We hadn't done a deal with All Seas. We hadn't done a deal with an onshore processing. And so we envisaged the costs. In fact, we went out to market, the cost building a processing plant and also a fleet of production vessels. And it was going to cost about $7 billion. And so the first block that we developed, we know it as Nor Area D. It's about 22% of our defined resource. When we published our PEA, had an NPV around $6.8 billion. That was after we paid for all the capex to construct. Now, it's very sensitive to commodity prices. If we punched in today's commodity prices, which many people think are quite depressed, that NPV is in excess of $14 billion, still allowing for the fact that we would have $7 billion of capex. But what we've shown the market is that we don't have to spend that money because we can do creative deals like we've done with Allseas. We can be creative on the onshore processing by finding assets or processing plants that are underutilized or that can take our feedstock. We'll sacrifice a little bit of margin, but the fact that we don't have to spend capex to get there is just a phenomenal outcome. And so, one of the great things for TMC shareholders is that we have one class of shares, and they're the class of shares that I own, that all of my executive team and every person in the company owns. And if you go and buy stock on NASDAQ at TMC, you own the same class of shares as us. So protecting the equity is of paramount importance. And so we're going to continue to grow that business because let's say $14 billion NPV, and that's only 22% of our defined resource. So that's a big number. And our job is to make sure that we can tap into as much of that as we can for the benefit of our shareholders. And it's not just our shareholders. There are other stakeholders because we also share a lot of benefits with our developing nation sponsor. And in the case of Nori, it's the nation of Nauru. We also will pay billions of dollars in royalties back to the regulator, to the International Seabed Authority. And UNCLOS was really clear what should happen to those royalties. They should be distributed to developing nations, particularly landlocked nations. So there's a lot of reasons to get this right. There's a lot of people that could benefit, as well as having the lowest impact on our environment and on the people living on it.
I get that you've got to do it the right way. Clearly, your land-based peers are going through the same issues. You're going to be doing this slightly where you've definitely got your own set of issues and challenges that you've got to face, and you've so far navigated your way through those. Sometimes getting a bit stuck in something, and sometimes working your way through it. But you are where you are, which seems that you've got a lot of people on board supporting this. So all good stuff. But what is a big destroyer of value, was a big destroyer of capital, is time. So you've been at it a long time. What are we looking forward to? What's the date we're looking forward to for some kind of exit? Like some kind of moment where you go, I can see revenue coming, so near-term revenue is one, maybe the addition of a large balance sheet partner is another kind of form of value creation. How do you see the path forward? What's the time frame? And why should people who are not in the story today think this is a good time to get on?
Well, consistent with our mission to protect equity, there is no doubt, we've told the market this, that we are talking to parties about investing at the asset level. And the good news is we already have our first production vessel. People can see that and go to metals.co and see the hidden gem that we used on our licensure last year, and that is having sort of modifications made to it, so it'll be production ready. And that vessel will be able to handle the collection of 1.3 million tons of these per annum.
What's that? I mean, give me something in a sense of dollar terms people can match on to.
Well, 1.3 million tons, take out the moisture when you process it, and we can turn it into between $500 and $1,000 per ton, depending on how far we process it.
Okay,
so that's the first one. We'll soon announce what the economics are like on the onshore processing. But between the collection, the transportation, and the processing, there'll still be a healthy margin left at this tiny scale, because our goal isn't to collect 1.3 million tons a year, it's to collect more like 12, 13 million tons on the Nori D block. So the idea of getting a partner in at the asset level is to make sure, we've also told the market that we will take some more money in before production, but we'll aim to do it at the asset level. And of course, there are many people who like that idea because the Nori area has been ranked the world's largest undeveloped nickel projects. We've got over 860 million tons of polymetallic nodules sitting there at 3.2% nickel equivalent. So it's a very large, abundant resource. And we're talking about first production, end of 2024. We haven't changed our guidance there.
Okay.
So that's like the end of next year.
Yep.
And the good news is, we've got a production vessel, we've announced where we're going to process them, and so all of the pieces are there. Now, there is speculation that what about the regulations, of course, because the final missing piece of this jigsaw, as I mentioned earlier, is the mining code. And that's on track to be in place by the end of this year. For those that follow the story, you'll also know that we lodged something known, or not we, but Nauru lodged the 2-year notice, which was in July 2021, which basically meant that after July 2023, we would be able to lodge our plan of work, our application, whether the regulations had been finalized or not. Okay, so that's 30 months away.
Lodge it with
the regulator, with the International Seabed Authority.
Okay. And what do they do with it?
They assess it. They had a legal and technical
From scratch, or have they already been involved with the process?
Well, they had been guiding us through this process.
Okay.
When we went and did our pilot collector trials last year, we had to submit a EIS for that, which they had to review and comment on. And they provide guidelines, as does the International Seabed Authority, the Exploration Code, that guide us as far as what we need to do when we prepare an application to move from the exploration phase to the exploitation phase. So that's what we're busy doing now.
Okay, so end of 2024, I got started my seat at that point. What's going to stop you?
I can't see anything stopping us.
Right.
To be honest, Matt, I can't see anything stopping us. And you're right that time is a great destroyer of value. And we've been very cognizant of that. And if I go back into, the last few years of the progress we've made since you and I first talked, when COVID hit, we just raised money. We decided to use the challenge that COVID represented to really fast track, because we were operating offshore. So we created cells. We didn't have a single COVID incident in 2020 or 21. We ran 4 campaigns, and these campaigns run for between 6 and 8 weeks at a time on our license area. Takes 4.5 days to get there by boat, by the way. In 2021, we ran 5 campaigns. So they were really busy, productive times. And, we've really been able to fast track the development of that resource at times when many other resource developers had their hands tied.
Okay, so coming back to the funding at asset level, what does that look like in terms of numbers? And so how much money do you need? You got a $7 billion total capex, but you're coming at us in a phased approach. So what do the next 20 years look like?
$7 billion capex was what the PEA said.
Right.
What we've been able to show the market is how we can get into business with no capex, and our job is to keep that going. I can see us...
Meaning what?
Meaning that I can see how we can get through all of our onshore expectations without having to spend capex on the NORI-D area for the pyrometallurgical part of the process.
So who is spending that money? What does it cost you? Nothing's for free,
Nothing's for free, but it's about, moments in time. It's about the fact that Indonesia has decided that they won't allow the export of their nickel laterite ore. So if you've got a RKEF that's been processing nickel laterite and it's not based in Indonesia, what are you going to do with it?
You want to fill it.
You've either got to decommission it or work with us. Now, we obviously are dealing with our friends in Japan today. We're talking to other people as well. We see many opportunities where we can continue to be capital efficient. But the reason why we're working at the asset level is because the NPV of NORI-D today is in excess of $14 billion. We told the market we need between another $100 and $150 billion to get to the other side of first production. Mm-hmm. We reported a few weeks ago. We'll report again in middle of May. We have no going concern qualifications, which means that we have at least another 12 months runway in front of us. One of our leading shareholders, Allseas, also just put in a unsecured line of credit for $25 million. And that was really just to give me a little bit more runway as we negotiate with some of these strategics at the asset level. Mm-hmm. So they see significant traction there from the parties that are sat around the table. And what we can do for those parties at the asset level, because I don't need $150 million tomorrow. it's between now and first production. And so I need it over the next couple of years, that a bit of working capital. And so we can build it around milestones. One of the milestones, of course, was showing that the offshore collector system worked. Check. Next will be the adoption of the regulatory code. And, we expect that's imminent. And then finally, it will be the issuance of the exploitation.
So I need to kind of start using some phrases that people perhaps more used to conventional mining terms might understand. So in terms of the IRR, given this phased approach and subject to milestones, I guess it's a little bit wonky. But how quickly do you get into production? How quickly does it ramp up? Because it's going to be based on a unit can do so much at any one time. They'll need to presumably have multiple boats, units working at any one time to kind of maximize the scale of the opportunity here. So there's a kind of cost there, but for the 150 million to now, first production, whatever that ramp up looks like, can you say to people, well, that we are going to be able to be cash flow positive or free cash flow by whatever it is, and what's the expectation of the return on that capital invested?
Well, we haven't released those numbers to the market.
Right.
But what I'm very confident about is that even at that small scale, we call it Project Zero, there'll be the production profile that the hidden gem can accommodate. Even at that very small production profile will be EBITDA positive. And if you think about that from an IRR perspective, that number is going to be through the roof because we're not having to go and deploy hundreds of millions of dollars of capital to make it happen. We'll be tolling the nodules with our partner, and we'll be paying for Allseas to operate that production vessel on a shared risk basis. And so it doesn't mean that we've got to go and buy a boat. Allseas already own that boat.
But that's kind of unit one. I'm thinking for unit. Okay, so maybe it won't be a perfect example of how you move forward and how you grow and you scale. Because for the starter pack there, which is using other people's balance sheets, other people's assets, redundant skills, and redundant infrastructure. Great. How do you go forward? Do you you don't own boats, but do you lease boats? Do you still continue to part with?
No, we let long-term contracts to partners like Allseas to put boats on the water.
Right.
Simple as that.
Same as airplanes. Okay, fine. Okay, fine.
And if you look at recently Transocean, who have, 20 of those drill ships, they recently just invested in one of the other contractors who also have a license area. And part of the deal was that they vended in one of their drill ships, Samsung 10,000, the same as the hidden gem.
Right, on the tree. Okay, I'd love to when you can share that, because we look at on the oil and gas side, but and how those metrics work.
And as I said, we think we can get good scale at that 1.3, just to let you know how the economics work.
Yeah.
That boat, engineered with a bigger riser and a wider collector, we are confident can do in excess of 2.5, 2.6 million tons. So that's double the production. Okay, it's double the production, but pretty well with the same cost. So that means your per ton cost of collecting could be cut out to half almost.
Right. Yeah. Okay. Understood. Okay. So, well, crikey. So that's imminent. I think that's the exciting bit of this conversation for me. You will see, because I deliver all of your wonderful promises, and be able to show the economics. So when do we actually get to see some sort of sense or announcement from you about the economics?
Well, in the second half of this year. Yeah.
Like end up.
Yeah, at the end of this year. By the end of this year, we'll have people will have numbers. I mean, you can see the economics of the at-scale model.
Yeah.
And at the at-scale model, we showed EBITDA margin of, in excess of 65%. So
Room for error. It sounds like
that's right. And room to also achieve up to a little bit of margin.
Okay.
In place with the CapEx.
Brilliant. Okay, I really enjoyed that catch up. Thanks for coming over. Are you going to skip back to the conference and see what the holds for you?
I am. Going to pick up that CFL and
repeat tomorrow.
Go and check the future.